Hello, everyone, and welcome to another episode of the Reinsurance Podcast. I'm your co-host, Jared Lee.
And I'm Ben Rose.
And we're back.
We are, and unfortunately already seated because today's topic is emerging risks. And I was so tempted to start with an empty chair and then just emerge and just be like, emerging risks. That would have been too cheesy even for us, I think. So
we could be like, Cordy, cut me in and fade me in.
I want to be a spinning newspaper that gets larger and gradually reaches full screen.
Like a Batman from the 1970s or something.
And cut to the... Brilliant.
But yes, emerging risks.
Exciting topic.
It is. I think when we spend so much of our time in this industry, not only in the podcast discussing it, but the industry evaluating and assessing is like the mega categories, right? It's property cat in big, regions, and it's big casualty, understood risks, marine, aviation, things that we've had for ages. But there's this real growth, and there's a ton of opportunity in areas that don't really have as much business yet, or there's, as it says on the tin, emerging risk categories. Cyber being the sort of most recent one to have emerged, but there's obviously a lot more.
Yeah, I think in thinking about this episode, a number of questions were immediately raised. Does emerging risks equal emerging products? Is insurance a product that is bought or a product that is sold? Is reinsurance a product that is bought or sold? I think it's bought, personally. But I think it's harder to say for some of these new categories where we haven't quite figured out how to match a demand for risk with potentially people who might supply it, or on the other hand, an overeager set of suppliers looking for something to sell, or even a way to create nascent demand.
Yeah, I mean, I think the buying versus is it bought or is it sold piece is an important one to start with. I think businesses are more successful when they have a product that's being bought rather than they're saying, I built a thing, don't you want it? Right? And I think a lot of insurance has fallen foul of that in the past, where they try to force products into people who don't really maybe have the need for it, or they have a very hard time articulating the benefit in a way that is sufficiently compelling for a buyer. They've resorted to scare tactics in some geographies, which feels a bit lazy, but it's like, if this disaster happens, don't you want your family protected? And it's this very... So I think we've done a disservice in some of that selling tactics. But with emerging risks, it's a bit different, because it's more of a, how do you think about this risk that you have as a business? Aon does a bunch of work around this, don't they, with risk assessments or emerging risk profile assessments for big companies.
Yeah, especially on the insurance side, every year or so, I think a few of them do something similar, but a report on which risks are uninsurable at the moment, as in you can't really get any kind of coverage as a customer, which ones are only partially insurable, and the important bit you still can't really insure, and which ones have we finally conquered, and mapping that against surveys of executives, for example, and saying, what keeps you up at night?
Yep.
And I think distressingly for the industry, on one hand, the list of things that are keeping up senior execs at night rarely maps to what they are able to buy protection against. And then on top of that sorry situation for the insurance industry as well, we've seen the overall expenditure on insurance relative to GDP gradually declining over the past 50 years or so. So typically the relevance of insurance as a means of helping CEOs sleep better has waned. It's a good word, isn't it? I haven't used the word waned in a long time.
It doesn't make it into most sentences normally.
No.
That's a really interesting point, though, because whilst there's certainly alignment between reinsurance spend to GDP as an assessment as to penetration, you could also make the case that as risk gets better understood and better priced and more easily distributed and everything else, that we're slowly stripping out inefficiencies in the insurance model, and therefore, I mean, there's a bottom there somewhere. I won't means to pretend that I have a way to understand what that bottom would be, but it might be interesting that improved efficiency in distribution and claims payments and everything else is helping to reduce the spend to GDP, even if it's not reducing insurance penetration in a developed economy.
Yeah, potentially. Yeah.
So that was an interesting angle that just was a side tangent as you said that. But more importantly, in an earlier episode, you talked about the ability for us to use new points of data to understand risk. And I think the idea of here's risks that are not yet insurable, it doesn't mean that they can't be insured. It sort of means with the current state of play, there's not enough, there would be no way by which we could sufficiently measure it, sufficiently track it, sufficiently evaluate it in order to provide a product around it. But as we're leveraging technology in sort of increasingly diverse ways, I think we're beginning to sort of unpack those things. And those surveys are the sort of 5 of the top 10 are similar every year, right? So everyone's aware of like, okay, if that's what's on people's minds, like how can we help solve that pain point?
And I think it's interesting because I will come on to the technology aspect here and how this could maybe shake things up a little bit. But typically, these emerging risks being hard is what you'd expect. Mm-hmm. And the reason I say that, if you go to some really standard consulting models, I mean, not standard, they were very clever when they were first thought up, but now quite well practiced models like the BCG product Lifecycle and Matrix kind of combo. Mm-hmm. You look at emerging products and emerging risks kind of as the same thing here. Emerging demand is basically what we're talking about. How do you build a product initially? Typically very high upfront investment, very low profitability. It's R&D cost. Mm. How do you create something that was not there before and hope that it finds a market? That kind of product, typically, when it's first launched, has a very low penetration in the market and very low growth. Mm. It doesn't exist. And that is something we call a question mark, typically. Mm-hmm. And not many insurance companies are willing to take risks in general without data, without historical underwriting years to look at on these so-called question marks, let alone willing to behave like R&D heavy companies like pharmaceuticals, etc., and spend millions or even billions on developing new question marks. But the rewards can be really huge because the sort of subsequent category to question marks is stars. And the idea of a star is that it's a really low penetration market where there's hardly any players, but there's really high growth. I think we saw this in the early days of, standard terrorism products and cyber products, where suddenly people have realized, whoa, there's loads of demand for this. Nobody's supplying it. We can charge pretty much whatever we want because people need this. They want it. They've only just realized they need it, and we're the only provider that offers it.
Yeah.
And if you can catch on to one of these stars, you're on a rocket ship from that point onwards in terms of sales, grabbing market share, grabbing loyalty that can then be quite sticky going forwards. I think the problem is that you can then get to a position quite quickly where those products become standardized, especially in subscription markets where you need many players to be part of a risk, especially a new risk. Mm-hmm. You very quickly get to a kind of commoditization period where growth starts to slow down. The market kind of is what it is. Penetration is very high at that point, and you're stuck with what's called a cash cow. So there's loads of money coming in, but actually you're really fighting for margin at that point. It starts to get quite competitive. And it can get to the point where eventually you're actually seeing very low profitability to the point where people start withdrawing from the market, penetration reduced. Nobody actually wants to write this thing anymore. Probably a bit like the D&O, I think, has gone through some cycles a bit like this in recent years, but it's a bit like that's what we call a dog, something nobody really wants to be in anymore, and people are trying to offload themselves out of that class and look for the next big thing instead to allocate capacity towards. I think that applies just as much to the insurance world.
Yeah, I think it does as well. I think we're in a good spot there because this sort of these large organizations are very clear about what pain points they have, what keeps these sort of Fortune 500 executives up at night. So when you think about product development from is this a painkiller or is this a vitamin? This executive community is going, this is a pain. Like, if you can give us a product that kills this pain, like, we will pay for it. So I think there's this real ambition there to go, okay, what might we do there? But you hit the nail on the head that if it takes a lot of energy to build this product out, who's willing to do that investment? And even if you have, and there's some companies that do this in their innovation units and similar, even if you have it where you're partnering with a couple big players early on to build this out, even though they're getting their pain point solved, they don't want to do that for free always. They might want a bit of a take on that business, or they might want, a carrot or something as a result of all of that hard work as well. So you begin to make it where it's still hard to innovate and create that product from scratch, because you need collaboration with that end client, at least the first couple, to get that product into the market and have it, meet the needs that they have. But it's not nearly as clear as to who's going to foot the bill, and is that bill sufficiently worth it? Even though all these executives say this is a big pain point, if they all bought it, would it be a $100 million product for you, or would it be, few million dollars? And in which case, all that R&D is for naught. And
it's super interesting, and I think the latency with which the insurance market has addressed these emerging demands from their customers has actually led to a scenario where, instead of individual insurers developing new products, which has happened in pockets, don't get me wrong. I mean, there's some
for sure
players like CFC, for example, who've got fabulous reputations for, here's a product that nobody realized could be huge, and really took it and ran with it. But what's happened in the absence of that is we had things like the InsurTech movement, and also things like the Lloyd's Lab here in London being set up, whereby they had whole cohorts scouted and researched to tackle certain problems, and then venture capital has come in to support the furthering of data sets and approaches and methodologies that would enable capture of sufficient information to enable a class to emerge.
Yeah.
But what that brings with it, because of it being an external partnership, is a additional person who wants some of the upside, right? So, which can work really well. I mean, we talked in the past about the brilliance of SaaS and everything costing much less because it's multiplied.
Yeah.
You've got many people to pay for a product rather than just one insurer. But because insurers, I think, haven't put their own money into things a lot of the time, or pooled it, ironically, in an effective way, it's meant that, for example, we talked about cloud outage insurance. That's a startup that's coming in and doing that with venture capital money. And if they've got the way of doing that and no insurers have, they're probably going to want to charge lots of money to those insurers in order to access that type of business. We won't necessarily see any one insurer emerging as the champion of a new product class there, except maybe the early partners of that new product class.
Do you think that the multi-party in the value chain slows this process a little bit? In which I mean, if an insurer gets really interested in deploying a new product into the market, but it's not very far until they go, we don't want all of that risk, even if it's pre-star status in the BCG model, even if it's just beginning to grow. There's a real reticence to sort of just therefore assume everything, because they still want to learn. And as a result, they will then require support from their reinsurance partners. But that also means educating and getting those partners to buy into that, which you can already see a slowing of innovation, just as that you're reliant on a few parties wanting to go on this journey together. And when you work with enterprises like the insurance and reinsurance industry, that just doesn't move very quickly.
I think it comes down to I don't want to say a misalignment, it's almost an absence of appropriate shareholder class in our space. So if you think about insurance company shareholders, typically what they're looking for is a very predictable, stable return. You're looking for that company that gets 98% combined ratio and improves that further with an investment return every year, very predictably, and all the volatility thrown out the back to reinsurance companies. So that might make you think, okay, so maybe insurance companies aren't the ones to experiment with these unknown products that could have very volatile results and very high upfront costs. Maybe that's the reinsurers, because the reinsurers like really volatile portfolios. But then again, a big part of the reinsurer philosophy is that they take on massive volumes of portfolio risk such that they're able to hedge between volatile parts of portfolios. And with any question mark type new emerging product, typically the volume is negligible. they're saying, we think we can sell 10 of these in the first year, and that would be a massive achievement, and it's not worth the reinsurer getting out of bed for that type of thing. So there is, I think, only really this sort of early stage seed type venture angel kind of investment bed for these new products at the moment. And I think it has worked quite well in many instances to provide parties who are willing to take quite a big risk on a new idea, even though it isn't going to be big initially, even if it is going to be very risky initially. So it's fallen out of the insurance industry and gone into a more generalist, high risk, low volume kind of market instead. Point of view.
It's super interesting, right? Because you have it where the inherent characteristics of the insurance company make them really avoidant of R&D cost with no real return. And then it begins to become, as you said, like every large organization, there's a reason that Google doesn't build tons of new products and just waits for someone to be interesting and then buys them. Because Google investing in building something that's going to make them $3 million a year is not worth anybody's time.
Which is why they keep discontinuing my hardware.
Exactly. But it's the same thing here. If you went, this insurance product we could make $50 million a year selling this. Munich Re literally doesn't blink to that. If the turnover of an organization, the big reinsurers, is so substantial that like 50 million on like gross into our written premium is I'm not going to spend that, but I have to employ some underwriters to look at it. We have to update our tech stack to supply it. The amount of effort becomes too burdensome if it's not that big.
And even then, you think about that the other way around, 50 million, and I took that number as revenue, so premium rather than profit, right? Because profit would be then potentially 100 times that or 50 times that, depending on what kind of margin they're doing. But for a startup or for a new emerging risk tackler of some kind, 50 million, depending on what you're selling, presumably you're not selling 50 million pound policies or even 100,000 pound policies. You're talking serious volumes of, maybe it's 5,000 pound policy, but that, even to get to that stage, it's quite a big leap for any company. And probably actually what's going to happen is you're going to have a 200% loss ratio until you figure out the price. Interesting.
But these are the things that when you look at the emerging classes and how we think about what risks that emerge next, there's a number of ways that they solve for this, right? It's identifying where there's a sort of a white hot center. There's a need that's emerging that people want to tackle. Oftentimes I do think you're right. It's startups kind of going, well, we could solve it, and then just get some capacity support and then chip away at it. And that's interesting enough, and you align the shareholder class enough that begins to be something of interest there.
You need those people who are either voluntarily or involuntarily unemployed to take on these difficult challenges.
Exactly. And then over time, it becomes something where, Munich goes, this is super interesting. We just want to buy this and hold it in-house, or Swiss or Hanover, whomever does something similar. Or it sits there running very happily as a technology company that sells insurance products and is worth, £1 billion or something.
So we'd be remiss not to spend a bit of time in this episode talking about some of our favorite new emerging risk classes and dreaming up some that are yet to exist. So what comes to mind when you think about those areas of the market that are tragically unaddressed at the moment?
I think there's always been a lot of attention into healthcare. And I think we talked about this on the partnerships piece, but like stuff that Gaia is doing, identifying areas in healthcare that have been sort of ignored and haven't been covered by the traditional health sector. But, you want something, but there's not a chance it'll, fertility treatment, for example, will work, but it's expensive. If you do it 3 or 4, all of these kinds of things. I think that's a really, really interesting one. I think for me, that one feels very personal. Like it resonates with a human element of me versus, what keeps the CEO of GM or, Daimler up at night. But I don't feel like the profits of a massive organization resonate quite as much as, human experience in that same way, which I think why healthcare gets such an interest. But there's obviously certainly opportunity in those other sectors as well.
No, absolutely. I was just trying to think of a matrix to express this within, because I think healthcare is a really important fundamental thing that we look at and say that's something that should be insured. Why isn't it available more easily, more affordably, etc.? And I was thinking in a similar line when we talk about, as we did on the recent news episode, the insurance protection gap. We're mostly, when we talk about the protection gap, referring to those coverages that we expect in many very developed economies to be mandatory or bought by an overwhelming majority of the population, your homeowners, your auto insurance, things that it would be very strange if you didn't buy them, because you'd be exposing yourself to a massively unaffordable risk that you could avoid for a relatively low cost, or that you're legally obliged to pay to avoid. But actually, I think one of the biggest emerging risk areas as a category, as a sort of area of this imaginary visual that one day we'll publish, is those risks which are smaller, but still annoying and still, setbacks to financial goals and financial well-being, but that would require too much effort at the moment due to inefficiencies in the sales process or the claims process, or too much uncertainty in their processes for people to actually take the time or to have the trust in as things that they would actually go out and buy and claim on proactively.
Yep.
I think one beacon of hope in this space recently has been the growing uptake of what we call parametric products. The concept here being, that you can effectively guarantee a payout based on certain parameters, hence the name being met. So flight cancellation insurance can be made parametric on the basis that I think AXA made a product ages ago called Visi or something. But
it sounds
as one example. But everybody knows if the flight has been cancelled, it's on departure boards. It's very available via APIs by now. So if you've got a ticket to be on that plane and that plane gets cancelled, you shouldn't have to claim. You should just get a payout. And that purchase should be a no-brainer at point of sale, right? And then that's a hassle you as a customer don't have to worry about. It's low severity as a risk. You're not going to go bankrupt because your flight was cancelled. But if it was a expensive flight and there's not a good suitable available, the cost is very frustrating. But likewise, you're not going to go out of your way to compare providers and try and figure out how it works. And then after it happens, try and manage a claims process to get the funds back in your account to buy something else. There's a huge number of products in that category of small things on which data is widely available as to what has happened with certainty that I think is greatly underutilized at the moment.
And it's a combination of finding distribution in the best way and leveraging it. And because I recently had a flight canceled for a similar reason. And again, it was solved for, but it took like 2.5 months to get like my 300 pounds back. It wasn't impacting my life, but it was annoying that it was on my to-do list to like chase this thing for like as long as it was. And if you had it where it's like, as I'm leaving the airport, and whether you could even embed it with, because a lot of like credit cards will come with health or travel insurance embedded, just make that built by one of these things where if you book the flight on that card, it links it up, applies it, and then you immediately get your 250 pounds the second you sort of deplane. Like these things make it super interesting. I also think when you look at how technology will have an impact here, it feels a lot like how much of like Africa, for example, skipped the traditional telephony grid and just went right to cellular. You could do something similar where they've skipped the traditional infrastructure of the original insurance supply chain and just goes, well, when I buy fertilizer, it comes with a parametric product that if there's a drought of this, I get 4 times the price of this bag of fertilizer. It's all just embedded. Like parametric tells me when there's a drought, and I don't do anything more. It's like included there and covered, right? This idea where it moves out of the way. And I think the industry is really paying attention to those things. And you're right, the existing model doesn't make it work financially. There's too many things that need to be done. But if you use these opportunities to leverage technology in a way that gets stripped away and you're only working with the pure costing of it, then it begins to be something that can be very interesting.
I would love to leave us on that final note for the episode, because your leapfrog analogy matches our green background and also gives the listeners lots to think about as they wait for the next episode of the Reinsurance Podcast.
We'll see you there.